Probal Sen, Senior Research Analyst, Indian Oil and Gas Sector, Institutional Equities, ICICI Securities with us now. Probal, very good morning to you. And, this is, excellent time to talk to you once the market has sort of responded and ingested what's been happening with Gujarat Gas. Let's start with the big question we've been discussing in the studio. Why the love for Gujarat Gas and a bit of concern about GSPL from the market this morning?
Honestly, hi, am I audible?
Yes, absolutely, Probal.
All right, sorry. So I think the concern around GSPL is not so much really a fundamental concern. It's more, I think, that the stock markets had already had an inkling in some way of what was going to happen to the story. And, and therefore probably there was a bit of profit booking of people who had built up positions earlier. If you look at the price on Friday, the stock was already close to 5% of the swap arrangement, derived fair price. So thankfully, the stock is again now coming back to the 465 odd levels, which is, implied by the merger ratio. So to that extent, I would say that GSPL is more of a, short-term tactical moves that were basically being done because of the fact that the stock had reacted early. Gujarat Gas very clearly, is something that is likely to benefit from this move, which is what the stock has basically reflected. A bit more than what we estimated, but that's okay. I think we still remain fairly positive on the name as of now.
Yeah, absolutely. Just one more point, Probal. You've explained, and you've very good note out where you've explained in detail what will help. But just for the benefit of our viewers, apart from a strategic outlook to this merger, in terms of earnings, what is the implication for Gujarat Gas?
So what is happening is, if you look at the gas trading portfolio of GSPC, about 45% of the gas used to be transported or sold to Gujarat Gas itself, on which they would make somewhere around 2.5, 3 rupees. They've not disclosed exactly the margin mix between what they were selling to Gujarat Gas versus what they were selling to someone else. But broadly speaking, of the 11, 12 MMSCMD of the trading portfolio, they sustainably can make about 1,000 crores of EBITDA. So if you add that number to Gujarat Gas, plus there is about 2,300 crores of cash that GSPC had, which you can basically say anywhere between 180 to 200 crore is probably the other income potential that gets added on. And of course, there would be some depreciation costs that get added and so on. Net of everything else, your PBT can actually average around 3,500 odd crores, as is, we've given a calculation in the note as well. Now, most importantly, you've got a 72 billion rupee tax loss that you can actually utilize over the next 3 years, which effectively means whatever you earn on the PBT line flows through to the net earnings line. So put together, that is basically what is adding the 15 odd rupees delta in terms of EPS on our current base case estimates for standalone earnings. So the number goes from somewhere around 21, 22 rupees, which we have as published estimates today, to an estimated 37, 38 rupees, basically once the deal is consummated and everything is regularized. So that is really the big jump that we see in terms of earnings. Most importantly, if you look at the savings that they could make in terms of the margins that they no longer have to pay GSPC, there is a sustainable improvement in gas costs, therefore, going forward, which they can either partially retain, they can fully retain, whichever way you look at it. It can result in better volume growth or stronger margins, or a combination of both as and when we go along. And I think that is something that will be more structural in nature over the next 3 to 4 years.
Quickly play devil's advocate, and I know you like Gujarat Gas, and the street is also enjoying this. As we see it this morning, it's up 13%. But the fact is, this is a very expensive stock, or has been. The earnings were a disappointment. They downgraded the outlook in terms of volume growth. The dependence on Morbi also makes it extremely earnings sensitive to what comes out of there in terms of PNG volumes, which were expected to decline in September. Do you feel this is just a sentimental impact, and operationally the gain on margins because of cost optimization as intercompany costs will come off will offset the operational concerns that we have with Gujarat Gas, or had until 2 days ago?
Okay, so as far as the September quarter is concerned, you're absolutely right that the earnings will be basically weak. And to be fair, we've had a sell rating on the company for a while now, primarily because of the concerns that you raised, that the volumes from Morbi still have an outsized proportion in the overall business of the company, and those are inherently volatile because they are competing against propane prices, which have also been up and down. And therefore, that makes earnings predictability very, very difficult. Those points notwithstanding, the one key change, which is why I mentioned that the one key change that's happening in terms of the control over your sourcing and control over your sourcing costs, that straight away adds a lot more leeway in terms of your pricing power, in the sense that propane volatility can actually be more effectively addressed because you've got much more room to play with as far as your sales prices are concerned, because you've got more control and moderation in gas costs than was possible even before this deal. That is number one. If you really do the math, there was about 5 MMSCMD that Gujarat Gas purchases from GSPC, on which if you take out the two and a half to 3 rupees that was being made as margins, that straight away adds an effective 2 rupees to your gas cost that you can play with, which takes care, in some ways of around $20 to $30 a ton of variation as far as propane prices is concerned. So that is, I think, a significant change that happens. The second thing is that it effectively provides a hedge. Trading business has been surprisingly stable and on an increasing trend, both for GAIL, and if you look at the margin trends for GSPC as well, the kind of pricing that we expect for LNG and spot LNG prices going forward suggests that trading business will continue to do well, and that anyways therefore effectively acts as a hedge in terms of overall EBITDA potential for the next 2 to 3 years. And as I said, the tax benefit that is there, it's a real tangible cash benefit that you're getting because you're avoiding having to pay tax. As per the merger rules, you're allowed to basically offset this for the next 7 to 8 years. And I think that's a very, very powerful tool as far as earnings strength is concerned over the next 3 to 4 years.
Just one question, Probal, and of course the merger, etc., streamlines the whole situation for Gujarat Gas, seen as a positive. But moving forward after the merger news, do you see regulatory issues as perhaps one challenge for the space and of course Gujarat Gas, especially what happens or what keeps happening with city gas distribution businesses? Is that a possible sort of cloud on the horizon?
I think the regulatory challenges are going to be faced by the transmission entity. There is no doubt. Even with the carve out that should happen, the concerns that are there around GSPL will continue to be real and valid. So, while the management is very confident that they will get additional capex authorizations and they could get a favorable review of the tariff that was basically cut by close to 45% in the last review order, the fact is that the new entity, as and when it emerges, will be facing the same challenges, that the tariff is obviously much lower than what they were earning before the last tariff order came through. As far as the CGD business is concerned, I believe the major risk is that if priority gas allocation actually continues to decline at the rate at which it is declining, I think that presents a real and present danger as far as margins is concerned. Because if you have to keep replacing $6.5, $7 an MMBTU gas with even $9, $10 MMBTU, that is something you have to either pass through if you have to keep your volume growth going, or you have to take a hit on your margins. Both can't happen at the same time. So I think that is the main risk. I don't see any huge regulatory risk in terms of competition coming in or open access and so on, because frankly, the availability of gas itself is so restricted, specifically for the priority segment, that the potential of a third party coming in and grabbing business from an incumbent player and getting gas on the same terms, I think is very, very difficult. And at least it's very improbable. Let me put it this way, at this point of time.
Probal, we're obviously short of time, but I quickly want to get a view from you on what's happening to marketing margins. Crude has been up and down, $80, 76, settling now lower because there is a downside bias. Will this have a structural impact on the earnings of OMCs and also ONGC? Now, this one reported earnings that missed street expectations. Stock actually went up. And it's had a very sort of volatile move. There have been a few upgrades as well, which I'm mindful of in the last few weeks. But I also know that you've been constructive on ONGC for over a year. So quick word with the structural impact on OMCs on back of crude, and what's your call on ONGC in all India while we're at it?
How much time do I have?
You have 2.5 minutes.
Okay. ONGC and Oil India, it's a very simple, binary equation. Net realizations, as I've said earlier as well, are fixed at somewhere between $74 to $76 a barrel. So if crude actually goes even below the current levels that we are seeing, that is when a little bit of concern emerges, because even if windfall taxes are removed, your net realizations will fall below what you have been making, at least over the last year or so. I do believe that the correction in Brent and WTI seems to be a bit excessive. And if you look at the inventory levels, there could be a little bit more correction upwards. I still believe that $80 to $82 is a more reasonable range for Brent. Therefore, net realizations for ONGC and oil can continue to be at the levels of $74 to $76, which, which is definitely higher than the last decade average, and should continue to support earnings. The other more important equation is that if you look at their production plans, specifically for Oil India, the kind of performance they've put together in the last 6 to 7 quarters, their production growth has been much higher than their long-term averages, and the guidance that they've given for the targets of oil and gas imply that they could continue to deliver 7 to 10% production growth on an overall basis over the next 3 years. As long as they can deliver on that, I don't see a threat to valuations or to earnings, because that is pretty much above what they've delivered in the last decade or so. With ONGC also, it's more of a single asset story. The KG Basin asset has to continue to deliver, the guidance that has been given. There has been a little bit of delays here and there, and frankly, that's been the story for this asset for ONGC. But given that the asset is producing gas, they've added a couple of wells in the last quarter as well, and they are still on track to reach about 8 to 10 MMSCMD of gas and about 40 to 45,000 barrels of oil per day by the end of this year. I think if they can achieve anywhere close to that, the stock should continue to do well. Realizations, as I just said, the one bet I'm taking is crude doesn't collapse from here. If that happens, we'll be forced to revisit our earnings assumptions for sure. So that's the one looming threat, and that's something that we can't really help. I think you also asked about marketing margins. See, I think it's basically a story of what the integrated margins look like for the OMCs. Refining margins have definitely come off again in the last 7 days. They had been recovering quite sharply from the low level seen in the first quarter. They had come back to about $5.5 from the levels of 3.5. I'm talking about Singapore margins. So, the decline again back to $3 levels is a bit of a concern. But at the same time, marketing margins, would average about 3 to 4 rupees a litre on a blended basis for 1Q, are trending at well over 7.5 rupees right now. So it really is a game of integrated margins being the same levels. Then OMC should continue to be okay.
All right. Thank you so much, Probal. Always a pleasure to speak with you. That's actually the big story this morning. Just pull up Gujarat Gas and GSPL. GSPL's recovered sharply from where it opened at least, and that's what pre-show pairing off, but still about 2.5% up. Gujarat Gas is the cracker this morning, about 11% up.